Welcome back. Let's take another caller right now. David in Truro, Nova Scotia. Go ahead.
I'd like to ask Mr. Burrows about Amazon versus Google. Or would you have a different technology play you'd like to have, sort of? Or would you buy like an ETF? I'd hang up and listen. Thank you very much.
David, that's a tough question. That's the battle of the titans. And I'll say right off the hop, I would own them both and do own them both. Okay, we really like to buy companies that are disruptors. Really have done that. So when I look at the themes in this market, the leadership coming into the correction in December was consumer discretionary and technology. And when you looked at retail, if you looked at the retail ETFs, they looked pretty good. If you went under the surface, you said, well, what's going on here? Some good, some not so good. Amazon is crushing a whole bunch of other retailers. So I like Amazon for their retail business. I also like Amazon for their cloud business and their services business. So it crosses over really technology and consumer discretionary. Google, of course, for search. Is very attractive. So I'd own them both. You could also go and buy the ETF PNQI, which is an internet-based ETF, which gives you a basket, which might not be a bad idea, or FDN, which is the Internet Retail ETF. And we use that in our global macro strategy.
Interesting. All right, let's take another caller right now. Mike in Mississauga, go ahead.
Yes. Hi, David. How are you?
Great, thanks.
I need your expert advice regarding euro. Is this the right time to convert euro into Canadian dollars now?
That's a great question, Mike. A lot of people asking questions about currency over the last little while because, of course, there was such a strong theme, weak Canadian dollar, strong U.S. dollar against the rest of the world's currencies. And, of course, in the last 4 months, U.S. dollar really has rolled over and is now trading significantly below where it was a year ago against most world currencies. So, the Canadian dollar's had a great bounce from the way people look at it, 68 cents to 78, 79 cents. That's been great. I would say that it is likely longer term that CAD is a little weaker versus US. Euro, I think, can continue to appreciate. Very often early in the cycle, the US dollar will be very strong. And as the rest of the world starts to catch up a little bit, you'll get strength in the euro and the yen. So I think you can make a case. In fact, today in our global macro strategy, we added some additional Europe exposure unhedged on currency. So we're making a call that we want to have some exposure to Europe and the euro. So I would be inclined right now to be more Euro-centric than Canadian. Canadian dollars had a great retracement rally, much like energy has had, much like metals have had. The question is whether it's a shorter-term rally in a down market, which is, I think, more likely. Longer term, I'd prefer to have euro.
David, how much, though, do the central bankers play into your thinking here? Because the reality is most people think that majority of the central bankers, ex the Fed, are going to keep lowering rates and moving into negative rate territory, and then everybody's debatable in terms of what the Fed will do.
I think that it's very clear the messaging from central banks has been, we will do whatever it takes. So you can expect that the central bankers will err on the side of keeping the pedal down as far as putting liquidity in the market for longer than people expect. Having said that, there are some really clear signs that we may be in the earlier stages of reflation. Everyone's come to the view that we have disinflation. We are at 1,000-year lows in interest rates. So think about this. When you buy one of the 3/4 of all the sovereign debt bonds issued in Europe with a negative interest rate, you're buying them at the most expensive price in history. Okay. Now, I'm not saying that rates are going up a whole bunch in a hurry, but I would say the risk to the investor is much greater that they can start floating higher than lower. And so when we look at what's happening with gold, and when we look at what's happening with things like wage inflation in the U.S., there are some changes at the margin, and I do believe that we may be at an inflection point where stocks take over return from the bond market. So I know that everybody is of the view that the central banks will keep pushing liquidity into the system forever, and that's how we got here. But we're now at a real extreme, and I think that it's possible that over time, over the next 3-4 years, we go the other way.
Yeah. Okay. All right. We're going to be back after this short break. Past picks are coming up next.